Portfolio winners and losers, July pullback and August stabilization. Welcome to the latest Cosmic Algorithm and Backseat Trader monthly portfolio update, covering the July pullback, the first signs of stabilization through August, and the winners and losers from the latest closed trade cycle. The latest dashboard covers positions opened on the 6th of July and closed on the 4th of August, 2026. It captures the risk side of the strategy's recent momentum concentration. Cosmic Algorithm fell by roughly 16% through July as several of the Nasdaq 100's strongest preceding leadership groups repriced at the same time. These included semiconductors, memory, storage, artificial intelligence infrastructure, and related technology companies. Preliminary August performance of around +1% suggests that the decline has stopped accelerating. This should be viewed as an early stabilization signal, however, rather than confirmation that the drawdown is fully over. The portfolio holds 20 separate companies in order to reduce dependence on any single stock. But 20 different companies do not necessarily represent 20 completely independent sources of risk. Many of the holdings operate within connected parts of the Nasdaq 100 ecosystem, including chips, semiconductor equipment, memory, networking, cloud computing, and cybersecurity. When expectations around artificial intelligence capital expenditure, valuations, interest rates, or semiconductor demand shift sharply, a number of otherwise distinct companies can move in the same direction. July demonstrated this sector correlation risk very clearly. Turning to the strongest relative performers in the latest cycle, DDOG gained 7.54%. Cloud observability and security remain supported by expanding artificial intelligence workloads and continued demand for monitoring increasingly complex digital infrastructure. Cisco Systems gained 4.99%. Artificial intelligence networking and data center demand remained supportive, helped by a stronger outlook for artificial intelligence-related orders. Fortinet gained 2%. Strong late July results reinforced expectations that wider artificial intelligence adoption will also increase enterprise cybersecurity requirements. CrowdStrike gained 1.63%. Cybersecurity held up better than the semiconductor complex as artificial intelligence-driven threats continued to support expectations for security spending. Palo Alto Networks declined by 1.62%, but was still the fifth best performer in a deeply negative portfolio cycle. Platform consolidation and artificial intelligence-related security demand helped limit the decline. At the other end of the portfolio, Intel fell 23.27%, KLA Corporation fell 22.25%, ARM Holdings fell 20.32%, Marvell Technology fell 15.07%, and Lam Research fell 14.73%. All five were close to the center of July's semiconductor and artificial intelligence capital expenditure reset. Intel and ARM were particularly exposed to changing expectations around artificial intelligence compute demand and valuation. Marvell was exposed to custom artificial intelligence and data center spending, while KLA and Lam Research were directly linked to semiconductor equipment capital expenditure. Their losses were amplified by a broader rating of a chip trade that had previously become exceptionally strong and crowded. The wider Nasdaq 100 context helps explain the move. May brought record highs as enthusiasm around artificial intelligence, memory, and semiconductor demand accelerated. At the same time, the chip trade had become increasingly stretched. June exposed that fragility, with sharp semiconductor sell-offs as investors questioned the durability of artificial intelligence spending, elevated valuations, and the path of interest rates. July brought further selling in the chip complex and renewed concern over whether very large artificial intelligence capital expenditures would ultimately generate sufficient returns. By early August, however, the tone had begun to improve. Major technology earnings remained supportive, hyperscaler spending stayed strong, the Nasdaq recovered part of the setback, and semiconductor shares began to stabilize. The portfolio rotations also show how the strategy has been adapting. May to June was the largest repositioning, with only 11 of the 20 holdings retained. June to July was much more stable, with 16 holdings retained. That continuity left the portfolio heavily exposed to the same technology leadership that then reversed sharply. The August rebalance retained 15 of July's 20 holdings. Axon Enterprise, Cisco Systems, Microchip Technology, Monster Beverage, and Texas Instruments were removed. They were replaced by Astera Labs, Lumentum Holdings, Nebius Group, SanDisk, and Teradyne. This is adaptation rather than abandonment. 1/4 of the portfolio changed in response to updated relative strength, while the broader artificial intelligence infrastructure core remained in place. Looking ahead, the medium-term case for the Nasdaq 100 remains constructive if hyperscaler artificial intelligence spending, data center demand, cloud growth, and technology earnings remain robust. The risks are equally important. High valuations, treasury yields, inflation, geopolitical developments, and doubts about returns on artificial intelligence spending can still trigger sharp market rotations. For Cosmic Algorithm, the immediate test is whether August's stabilization develops into renewed momentum, and whether future monthly rankings continue to adapt cleanly if market leadership changes again. The key takeaway is that diversification by stock count does not eliminate sector correlation. The same interconnected technology themes that powered earlier outperformance can also magnify drawdowns when sentiment reverses. The discipline of the strategy therefore remains unchanged: rank, rotate, and rebalance according to relative strength, rather than attempting to predict the next market turn. Past performance is not indicative of future results. Investing involves risk, including the possible loss of capital,